Hi there, I'm Deep Dillon. Welcome to your AI Injection, the podcast where we discuss state-of-the-art techniques in artificial intelligence with a focus on how these capabilities are used to transform organizations, making them more efficient, impactful, and successful. Welcome back to your AI Injection. This week, we'll be learning about AI-powered fraud detection and risk management with Conor Burke, CTO of a fraud detection company called Inscribe. Conor completed a bachelor's degree in electronic engineering from University College in Dublin and went on to co-found Inscribe with his twin brother in 2017. His achievements have earned him a spot on the Forbes 30 Under 30 list. Conor, get us started by telling us a little bit about your background in AI, and what problem inspired you to start Inscribe?
Sure. Yeah, it's great to be here. Thanks for having me on, Deep.
Yeah.
So I'm a builder at heart. Growing up, I was always tinkering with electronics, and through university, I had my first real exposure to machine learning, and that really sparked my whole career in AI since. And more recently at Inscribe, we're using AI in particular in financial services for the purpose of fraud detection.
Mm-hmm.
And this is really interesting. And for context for the audience listening, I think it's really important to understand just what's going on in the financial services industry at the moment, just how much change is going on there. I think we've all probably interacted with the financial services industry over the last few years, whether it's opening up a bank account or a credit card. But there's like three or four big trends going on that I think are really like changing what financial services means. And the first one is everything is going online. This sounds like a very obvious trend for those of us in the tech industry, but over the last 10 years, there's been a massive shift from in-person branches to online services. So you may be using or have heard of companies like Chime or Cash App from Square. All these products, they're technology companies at heart, and we're even seeing some of the old, more traditional companies that were in branch, like JP Morgan, investing massively in technology. So this massive shift online and the focus on technology has really been a massive shift. And
yeah, I mean, imagine in the older days, you would walk into a bank, you might even know a banker, you might actually even have a community bank where somebody knows your family or something. It feels like all of that's gone. I switched to a bank that was in a different state maybe 30 years ago, but I think most folks, that's kind of a new thing where they don't actually necessarily have even branches where they are, etc. So yeah, that makes a lot of sense. And and then of course we're accessing through ATMs, we're putting money in and out electronically, directly. I don't know, a lot of folks, like my kids asked me what a check was the other day. So so it makes sense that would really affect this. So it sounds like there's some kind of fraud that happens. What kinds of fraud scenarios are we talking about usually?
Yeah, so if you take this like that context we're just talking about of like everything going online, you really have two very big problems coming together. You have this like very old problem of fraud that has existed since now the medieval times, or in the like thousands of years ago, just like the idea of like people trying to get access to money that they shouldn't be. And then you also have this other big phenomenon of just like cybersecurity and cybercrime, people accessing and committing crimes through the internet. And you have these two trends coming together, which, as you can hint at there, is leading to this all new types of fraud. So I think when I think about fraud, there's like, two main axes. There's one first-party fraud and the other third-party fraud. And to explain this lingo a bit more, is first-party fraud is when, let's say, you yourself are committing fraud under your own identity. And for example, you may be trying to get a mortgage out, but you're lying on your application to get more money. Or on the case of third-party fraud, you're stealing someone else's identity, or someone else is making up a completely fake identity. There are two big important axes that is important to note. And then the other axis is understanding who's actually committing the fraud. Are these opportunistic fraudsters, or are these professional fraudsters? And that's something we've seen arise over the last number of years too, is just an increase in both, the increase of opportunistic fraudsters, but also more professional fraud rings.
Yeah, I mean, it makes sense. Like a lot of the things you're describing aren't even unique to financial industry scenarios, right? Like a company like Google that, or anyone that has an online service has to make sure that, if it's not an anonymized service, like that you are who you say you are. And then there's always someone trying to steal your account at some point. That's a pretty common thing. And like all the vectors you're talking about. So what problems are sort of maybe more unique to the banking arena that are special to these scenarios of pulling money out or
Yeah, so I think first of all, what makes these probably unique is just a financial reward that's at the end. That's at the end here. So, for example, yeah, when a cyber criminal is trying to maybe attack Google, there's a certain financial reward. But I think in financial services, there's often a very immediate gain. So, the type of ones that are unique to, let's say, financial services is, let's say you're an SMB lender. You're trying to you give out loans between $100,000 and maybe $2 million to businesses.
Mm-hmm.
And the type of fraud that's quite unique to just like financial services that, I assume, let's say, Google isn't experiencing is someone essentially coming to this small business and representing themselves as a real business when in fact it's actually non-existent. So what we often see is people essentially fabricating entirely fake businesses. So what they'll do is they might create a fake identity of the people who run the business. They'll have, maybe a website. They'll have people on LinkedIn who work at this business. They'll create a whole set of fake documentation around, like, these are my fake bank statements that show I'm a real operating business. They'll create some articles on corporation to show that they're registered in this state. And from the bank's perspective, a lot of this stuff will check out. Their process for making sure that their ID verification passes may actually miss these fake ID documents.
So how sophisticated is the dark web, if you will, at providing tools for fake documentation? Like, can I go somewhere and take advantage of generative adversarial networks that have been, trained up to produce bank statements and like all these types of documentation, and then and even trained up to just provide this stuff for me, company names, etc.? Or are people kind of on their own?
Yeah, that's a good point. So there is definitely a range. There's definitely a scale, and we do see a lot of this at Inscribe. So we see some fraud that, as you mentioned, is quite primitive. And yeah, if you're familiar with the film, Catch Me If You Can with Frank Abagnale, there's a very basic masking of information, very primitive edits to documentation. But what we have seen lately is just, I guess, the use of technology to create better fakes. So it's almost gone to a point where the technology to create better, or has gone to a point where technology to create better fake documents has surpassed maybe a human's ability to detect those fakes. And that's where we really try to focus a lot of our fraud detection. How can we detect these fakes that don't necessarily rely on what maybe human fraud detectors were looking at previously? And
so are you using a lot of kind of GAN networks to sort of detect this? Because it feels really close to deep fake world, but it's not human faces, it's documents. And you got one model generating better and better fakes, and you got another model trying to distinguish fakes from real. And so it just becomes a war between these two networks battling it out until eventually you have really, really good deep fake whatever.
Yeah, it's a good point. So like, while we haven't been able to like confirm that the fraudsters are using GANs, there is on an abstract level that cat and mouse game is still happening. So yeah, while they're using some technology, we don't know exactly what technology they're using to get better. They're shooting them over to our service, and they're using our response to I guess train their algorithm. So we're the reward function of their algorithm essentially, and we do look out for this. What fraudsters are out there are actually maybe abusing our platform. So to figure out where our platform's actually weak.
So what kind of data are you? Oh, sorry. Go ahead.
Oh no, go ahead. I think that's actually a great question. Like, what data are we actually?
Yeah, I was going to ask. Like, so are you basing your assessment of whether a piece of documentation is a fake on the document, like the PDF itself or the documentation itself, or are you figuring out what business name they have and then going out and looking for an EIN number and then verifying what address they gave you aligns with that EIN number? And are you cross-checking with known databases of legit companies and legit people? Or
yeah, it's a bit of both, all of the above. And I will say though, what's just so interesting about documents themselves is just how rich of an information source they are. So as you mentioned, as you correctly assumed, the document itself actually has a lot of interesting artifacts. So this digital file, when it's transferred to a financial institution, actually has some evidence on it. So a lot of your audience may be familiar, like, a lot of files have metadata. That itself has information such as when the document is created, maybe even where and by whom.
And what tool created
and what tool, exactly.
Because I imagine if they're faking it, they might miss some of that metadata sometimes, maybe like the ones who aren't as sophisticated, so you can catch them a little bit quicker.
Exactly. And then you also have the construction of the file itself. So how is, in the case of PDF, how is that file actually created? And looking at the byte level information. And then you also have the information within the file itself, such as how is everything formatted? Does everything in the right place? Based on, using computer vision, you have now this ability to look at large quantities of data and know if something is anomalous or not. And then lastly, if you keep going up a level, you then have the actual details themselves, the information in the document, as you mentioned, the business name, and so on. And then these can be used then for further checks against external databases and so on.
So like I'm imagining like a model that honing in on certain email domains are kind of more suspect than others, maybe.
Yeah, and even the actual email address itself. So a lot of times fraud rings would like auto-generate fake emails, and there's a certain pattern to those emails versus a real email. And
gotcha.
you can also look at the email record. So like it's a bit like for a domain name, who is record lookup. You can see how long has this email been active for, and you can really discover a lot about an applicant based on all this metadata that comes through.
Yeah, that makes sense. And then how are you like training your models? Is it more of like kind of a combination of models, or do you have kind of like a unified approach? And if so, like, how do you think about training data and approach that?
Yeah, that's a great question. So I'll answer this question from the lens of one of Inscribe's primary outputs or fields, which is our trust score. So with our trust score, this is a score between 0 and 100, which indicates for a particular document how trustworthy it is. So 0 representing it's not trustworthy at all, and 100 representing it's completely trustworthy. So to like determine such a score, what we've taken into account is two things, primarily two things. The first is just how familiar we are with this particular document, and this is trying to replicate the human intuition when you see a document set from a customer. How familiar are you with that document set? So for example, if you've seen like a Bank of America bank statement 1,000 times, you kind of know what good looks like. And we try to replicate that intuition through machine learning. And then on the other side, another like primary input is, as you're kind of suggesting there, is a list of features with a logistic regression on top of it to determine how fraudulent a document may be. So we look out for everything from the metadata itself all the way up to the information in the document. And we've essentially put this like series of features into a logistic regression, which we then use to come up with a score, which we combine with just how familiar we are with this. And that gives us this ultimate trust score. And what we found is not only does this help to replicate a lot of the intuition that maybe a human fraud analyst would be able to, or would have previously done manually, but we've also enabled this superhuman level performance. And to answer your question specifically about training data, what's our actual training data here? And there's really the supervised training data aspect, and then there's unsupervised. So on the supervised side, we feedback from our customers themselves. So like they tell us whether something is fraudulent or not, but also we have our own internal fraud analysts and fraud experts that are able to determine and essentially label data that are good exemplars of fraudulent activity. And we can then use this to develop features on top of that. On the kind of like unsupervised learning aspect, then we also have this ability that as we get more and more documents and we have these features that we look for, we can start identifying anomalies. So if you gave us 100 bank statements from a particular bank, and then we notice maybe 2 or 3 have these unique characteristics, whether it's the file itself or information within the file, we can then look into that, investigate whether that's an issue, and then that develops this nice flywheel that over time this algorithm is automatically getting more intelligent and better at detecting fraud.
Yeah, I mean, the supervised case seems pretty straightforward. I imagine you have tons of positive examples of legitimate bank statements and and other statements. And then on the unsupervised side, maybe you get like a new bank that you haven't seen before. To what extent do you like leverage credibility of institutions in and of itself? Because I imagine there's the analysis of the thing, of the utility bill, what have you, and then the visual component where you've seen this thing before. But there's also just the possibility that somebody did a really great job of faking that particular company's thing. And then there's another side where the model might learn what it looks like to have a good legitimate document, and then it inserts a maybe illegitimate organization. So it feels like both of those pieces of information and approaches might matter.
Yeah, no, you're spot on there, and we've had to develop some safeguards to avoid these kind of edge cases. So as you mentioned, a new institution or someone or a fraudulent document that is a very good representation of a good institution. So what we've kind of had to consider here is like having thresholds. At what point does an institution, do we have enough confidence about what institution or documents from institution should look like? And we constantly look at that as a variable at our disposal to be able to make sure that we're taking advantage of all the data we're getting in, but avoiding the case where we're letting through institutions that is completely fake. So for example, if a fraud ring sent thousands of documents from a new institution we've never heard of before, how do we ensure that it's actually a real institution? So going back to this idea that fraudsters today are going to much greater lengths to commit fraud. And we've come up with a few heuristics on our side to be able to catch those.
Have data, have a hypothesis on some high value insights that, if extracted automatically, could transform your business? Not sure how to proceed? Bounce your ideas off one of our data scientists with a free consult. Reach out at zionics.com. You'll talk to an expert, not a salesperson.
And kind of switching gears slightly, so what kind of assurances do you give your customers, and what sorts of visibility into your fraud detection methodology do you give them so that they feel good about your process and methodology?
Yeah, it's a really interesting topic, and something we've prioritized from the very early days at Inscribe is making sure our models are explainable and auditable. And what this means in practice is, for every feature or for every feature that we look at, having a reason behind why we look at that feature. And also, secondly, having the constraint not to just feed everything into our models. So for example, I was talking earlier about all the data that is available. It's important to have constraint about not just throwing all the data at the model, but being quite disciplined about which ones from intuitive level and also a policy level makes sense as an indicator of fraud. So for our customers, that kind of approach has been really helpful. And then, lastly, also from the data perspective, explaining to our customers just where and what data we have trained on, and making sure that matches and closely represents their own data that they see, and making sure that that's well understood too.
So at the end of the day, do your customers sort of rely on you exclusively for their security, of some aspect of their security, or are they always kind of spot checking your results and maybe doing some sampling?
Yeah, so the ideal way of using Inscribe, and I guess the eventual goal, is that we can reduce a lot of the manual interventions. So today, with our trust score, what we usually recommend is, above a certain threshold, you can auto accept customers. And in this case, it's worth noting, 95% or 90% plus of your customers are actually good customers, and you want to accept them. And it's maybe only 3 to 5% of your customers that are actually fraudulent that you want to reject. So what we tend to do then with our trust score is, for the ones that we have low confidence about or low conviction in, we give it a score that is somewhere in the middle. So which indicates that we don't have that strong conviction, and we'd recommend double checking. So that's kind of like one way our customers are using us to have that confidence in our results. And another way is, as you mentioned there, just doing some sampling, understanding if there's any model drift. And very easy ways to do this, like, is the fraud rate increasing without an explainable reason why? So if we see we're flagging more applicants for fraud, and we go in and do a sampling of those flagged fraud, but we don't find, or we find a lot of false positives, or we don't find an underlying reason, that allows us to be proactive about updating our thresholds and updating our models.
Got it. One question I have is, like, you're clearly not the only ones dealing with trying to identify fraud. How is, quote, the world of the good guys? How are you all collectively going about sharing and helping each other to sort of win? And on the other side, how are the dark actors going about sharing and ensuring that they win? Like, is there coordination? For example, there's known lists, of bad credit cards. There's known lists of bad email. How sophisticated is the sharing going outside of your company into some collective repository and coming back into you? And how does the good guy sharing world differ from the bad guy sharing world?
Yeah, it's a really good point. And I'd almost say I think the bad guys are doing a better job at this than the good guys. So there is some work today going on to improve this idea of like a fraud consortium. So how can all of these entities within the financial services space share more data about who's committing fraud, what new fraud trends are coming up? And avenues we've seen this come through is, first of all, vendors themselves. So like companies like Inscribe, who work with multiple vendors, has been a great leap forward, I think, for the industry. So if you think back maybe 10 or 15 years, a lot of banks didn't really use vendors. They built everything internally, and there was no shared data and there's no shared knowledge. But the explosion, I guess, of vendors in this space has enabled more sharing of insights across them. Also, I think another thing that's really helping is the community of fraud leaders and risk leaders is definitely growing, and there's more openness to share what fraud strategies are working well, what new fraud trends are coming up. And then lastly, I guess a more technological approach is this idea of a fraud, the actual technical implementation of a fraud consortium. So as you mentioned, how can you have this centralized database of up-to-date fraudsters? So there are some projects going on trying to get there, but there continues to be challenges around coverage, around data access.
To what extent are there like conflicting incentives? So, for example, let's say you're doing, your company is doing a terrific job, your models are working fantastically, and your customers are, happy. And a huge component of your efficacy is your ability, for example, let's just say, to assess new emergent bad organizations. So if you're a purely good-hearted player, then you would publish that in almost real time as you determine these things. But then your incentives may not be there. So, like, to what extent are the incentives sort of disincentivizing productive sharing?
Yeah, no, I think you're right to say that. There really is this two schools of thought. There's one which is why should I share data that I've worked so hard to catch about these fraudsters with my competitors? And then there's this other school of thought of we're all in the same boat here. The rising tide raises all boats approach, which I think is becoming more popular. And I think one of the reasons why that shift in thinking is happening now is because in financial services, I think companies used to compete primarily on risk and the ability to determine risk, but I think now the boat is really turning and the direction is really turning towards customer experience and features. So what banks are competing on now is actually not like interest rates and risk, ability to determine risk, whether credit or fraud. It's more about how good is your customer experience, what new features are you developing that your competitors aren't. And I think if that keeps on continuing, we'll find more collaboration between organizations. And I'm quite optimistic about that. And in that kind of scenario, these incentives are more aligned.
So let me just make sure I understood that right. If you're a entity that specializes in detecting fraud, you're saying those entities compete more on features and less on the efficacy of their fraud detection. Did I get that right? Or were you saying that the banks and like the actual financial institutions?
Yeah, it was actually more on the bank side. So if you take, let's say, Cash App, for example, a very like modern fintech, they aren't competing as much on risk and ability to detect fraud as they are on new features and new capabilities. Whereas if you look back at a more traditional bank,
yeah,
they aren't really thinking the financial products and services they develop are quite common across all the banks. But today it's all about, how good is your customer experience, your digital experience on mobile, or just like new ideas.
Yeah, I mean,
changing money.
Yeah, I mean, I think that makes sense from the bank's vantage, but are you saying that there is some kind of disincentive for the fraud entities, the fraud detecting entities to share openly? Or are you saying that like, hey, we don't necessarily do the sharing, but we provide the data back to the banks who then in turn do the sharing of the detections? Is it something like that?
Yeah, it's more the latter. I think where vendors and fraud detection companies in the space come into is enabling the sharing, but it's a lot of the permission around sharing data does come back to the institutions.
Okay, I got it. So, but isn't there like a risk there that the only data that's sort of being shared then is maybe high level data, like bad email addresses or bad organizations, but maybe interim lower level data that could make a difference is not shared?
Yeah, no, you're right. And I think you do have this dynamic too of lots of fraud vendors, or lots of vendors in the space and lots of banks. And with any system that's complex, it's harder to connect the dots between the high level data, as you mentioned, like an email, and maybe some of the lower level data. For example, did the account or did the loan that this person take out, did that default within 3 months, 6 months, 12 months? Or that fraud vendor with that email may not have that granular data other than this person just defaulted. They may not know anything else about that. And, that does lead to some inefficiencies in this fraud network.
Yeah, I'm almost thinking that the incentives on the bad actor side are quite positive with respect to sharing, because they get street cred by like sharing a new area that they just suddenly hacked, or a new type of fake something or other, and they're like quite eagerly typically like sharing information. And I mean, I suppose it depends on the type of hackers or bad actors they are. Like if they're really good, maybe they act privately, but if they're novices, they might really want to share their exploits. I'm wondering if there's some role maybe for government or some nonprofit entities to sort of step in and just sort of flat out provide the incentive on the good guy side. So like if there's an entity that just pays for certain types of data, maybe that gives the fraud detector companies the incentives they need to like share more openly.
Yeah, no, it's a good point. I will say there are definitely some regulations out there that do push for fraud detection and advocating for the sharing of data and enabling the sharing of data too. That is, I will say, there is this massive dichotomy between want to protect everyone's data, even the fraudsters in some cases, and like when you are sharing data, you have to be quite respectful and conservative with that. But at the same time, yeah, the more sharing of data you can enable, the less fraud you'll have in society. But I am hopeful that the capitalistic nature of the financial services industry does encourage this sharing of data. And I think, as I mentioned earlier, this trend towards competing on more than just risk will hopefully be a big driver behind getting to that state where all these fraud detection vendors, or all these fraud detection teams at these institutions, can ultimately work with vendors like Inscribe to be able to share that data. And even at Inscribe, we ultimately do want to play a bigger role here, and almost be that common risk team between all the different institutions, that we can get that deeper insight, not only in the high level but also on the deep level data points.
Need help with computer vision, natural language processing, automated content creation, conversational understanding, time series forecasting, customer behavior analytics? Reach out to us at xionyx.com. That's XYONIX.com. Maybe we can help.
Just to perhaps touch on your previous point around, the bad actors and understanding what they're doing. It sounds actually like you may have already had a chance to explore this, but there is an awful lot of information online available to people who want to commit fraud. So if you look up, Reddit or Discord or any of these new social media platforms, there's communities out there telling people how to commit fraud against all these big name financial institutions. So they'll give you the document set, they'll give you where to log in, what to do, what not to do, what answers to give for each step of the process. And there is very much like open sharing of information of, how to get $100,000 for free off this institution.
Yeah, I mean, it's a real problem, right? I mean, it's a lot of these, message boards, places like Reddit, etc. They kind of pride themselves on being, kind of free speech advocates, and everybody understands the need to take down certain types of content, like blatantly like violent content, but it feels like their incentives to take down stuff like this it's not necessarily there even, and it's problematic. Like, I don't know what the right answer is, but I do want to, this conversation has been, it's been really fascinating, and I want to thank you for coming on the show. I think it's, I've definitely learned a lot, but I want to end by asking you to maybe jump out in your mind, 5 to 10 years into the future, and describe for me the world of the dark actors and how it's evolved, and the world of the positive actors on the fraud detection side and how they've evolved, and who wins.
Yeah, no, this is a great question. So yeah, I'll start this maybe on the bad side first, and then I'll end on the good. So I think what's fair to assume over the next few years, like FinTech is going to continue on this revolution. There's going to be immense innovation on financial products. Even over the last few years, is the rise of buy now, pay later. I'm sure the metaverse is going to play a big role, and then crypto again on top of it. So all these dynamics and new ways of doing finance is going to open up a lot of opportunities and a lot of holes in our current systems today for fraud. And I think the bad actors are going to be on top of this. And probably what tends to be the case is a lot of times the financial institutions are behind the innovation of the fraudsters that the bad actors are playing. So yeah, I definitely do anticipate I think fraud naturally, or like the fraud attempts will increase, and they'll adapt to the adapting FinTech ecosystem. And yeah, I think overall, if you do look at the stats, even over the last few years, it will continue on this rise. But to switch on the other side, on the good side, what the good actors are doing, I think what we're really going to see is there's more data than ever. So today we have more data than we've had even a year ago, and definitely more than 5 years ago. I think that's going to be the same in like 5 and 10 years time. There's going to be more data. So it's not just going to be maybe 20 or 50 data points you have today. You could have 500 or beyond, and these are going to be all like touch points and data points that fraud teams and vendors can use. And this is really where AI and machine learning is going to come into its own, and it's going to enable us actually to do something with this data. And as we were touching on there, we'll also hopefully at that point have this sharing of data. So each institution will have this immense data lakes of information. I anticipate we will figure out this collaboration of the fraud consortium question. So it will come down to how well can these fraud experts and our AI practitioners come together and actually develop the adaptive models and the machine learning models to be able to catch this new fraud.
Yeah, I think it's there's just a lot of stuff evolving in a way that's gonna, if nothing else, make the battlefield much more sophisticated. Because if I had to jump out 10 years, it seems like on the bad actor side, they're going to get much better at leveraging deepfake capabilities. The deepfake algorithms themselves are going to get much more capable. your fake documents, fake bank statements, fake all of that, it feels to me like will be really quite good. The obvious mistakes won't be there. Like whatever we're doing for CAPTCHA today will probably get more sophisticated. Maybe we'll introduce a lot more biometrics to kind of get in there. And then like it feels to me like certain technologies will kind of like come and be safe for a while and then fade off as they get less safe. So for example, my financial trading institution does a lot of voice recognition now. And so I've asked them to like not allow anyone on my account in just based on a voice match with mine, because I know that it's really quite simple to make phenomenal voice mimickers at this point. And so yeah, there was a period of time when nobody had yet come up with like a deep fake based voice generator that could go break into Fidelity or Morgan Stanley or whatever. So, and then on the good guy side, it feels like they have no choice but to increase the sophistication of the coordination and increase the sort of auditing of like the real human somehow. But it feels like this whole arena is just evolving so fast, and that the cat and mouse game, the low-hanging fruit is going to be gone, and we'll be in a more sophisticated arena where maybe it's still 15-year-old kids are able to play, but with very, very powerful tools. And as far as bad actors, and on the good actor side, hopefully we get better. But honestly, I'm kind of concerned about it. It feels to me like we need to be pushing much more on the provenance side so that we can track the provenance of things.
Yeah, no, there's definitely like the whole concept of using deepfakes and AI to like recreate or create identities. And you have all this information around online now of like being able to recreate someone's voice, recreate someone's face. So it's like, I guess it redefines what it means to be able to authenticate someone's identity. In the past, you used to be just having access to a passport or your driving license, and that's enough to verify someone's identity. But yeah, when you have technology that questions the validity of that,
and we can even just make fake humans now, right? Like we've gotten so much better. We can make a fake face. We can make we can make fake videos of the face. We can make fake voices to go along with the face. We can basically create little puppets, and that capability right now, we can still kind of do things like look at the biomarkers of some human face and whether or not the redness in their face is following a biological pattern, but that's going to get faked too on the other side. Like, so we're very much, I don't know what's going to happen, but I do think the battlefield will get way more sophisticated.
That's all for this episode of your AI Injection. As always, thank you so much for tuning in. If you enjoyed this episode on the role of AI in fraud detection and risk management, please feel free to tell your friends about us, give us a review, and check out our past episodes at podcast.xionyx.com. That's podcast.xionyx.com. That's all for this episode. I'm Deep Dylan, your host, saying check back soon for your next AI injection. In the meantime, if you need help injecting AI into your business, reach out to us at xionyx.com. That's XYONIX.com. Whether it's text, audio, video, or other business data, we help all kinds of organizations like yours automatically find and operationalize transformative insights.